How's everyone doing today? Welcome back to another episode of the Banker Next Door. I wish everyone a happy Mother's Day today. I hope everyone is having a wonderful Sunday afternoon out there as I come in to bring everybody the news this week. So I wanted to kick everything off this week with I saw this absolutely crazy article that I wanted to share with everybody. So this is about one of the largest banks in Australia. And this is basically a $267 billion bank. And it basically, I'll read here too, because it's a short article, but it says one of the largest banks in Australia is rolling out a plan to terminate cash and checking services. In an update to its website, and if I'm saying this right, Macquarie Bank, which has 267 billion in assets, tells customers that a digital-centered banking experience will begin in November. And the message read, in case you missed it, we're phasing out cash and checking services for all products. To prepare for this change, you'll need to start transacting digitally, a safe, quick, and more convenient way to bank. We're removing our cash and check facilities in a phased approach. The bank says customers will no longer be able to access a list of over-the-counter services at their physical locations, nor deposit or collect checks or order new checkbooks. And then so from Friday, November 1st, 2024, you won't be able to write or deposit personal checks, deposit or request bank checks, deposit cash or checks over the counter at NAB branches, or make a super contribution or payment via check. And then it says, please note any checks received after Thursday, October 31st will be returned to the sender. Once the changes are rolled out, customers will only be able to withdraw paper money from their accounts using ATMs owned by rival banks, with withdrawals capped at 2,000 AUD per day. The move comes amid a broader shift away from cash across the country. A total of 424 bank branches representing 11% of all banks in Australia were closed from June 2022 and June 2023, according to Australian Prudential Regulatory Authority, the APRA. At the same time, banks removed access to 718 ATMs. Now, not surprisingly, it says here, Australians held a rally on April 2nd to protest the widespread closures and bring attention to the country's move away from cash. It's not often I use the term gobsmacked, but I mean, my gosh, like I am just completely astounded at this. I mean, this is just it's just insane. And again, like somebody told me about this and I didn't believe them. I had to go look this up. I said, no way. I said, there's no way that a bank in the world would be doing something like this. But it just goes to show you that there are people out there that want us to move to this fully digital world. They want a central bank digital currency. They want everything to be, they want us all to live in this, kind of totalitarian hell where everything is tracked. Anything you buy, they can see. And then they can basically turn your money on and off whenever they want to. And this is a real thing. And I think we all have to be very on guard against this, and we have to be mindful against this. And I will say this to people, and I will say it, the day you give up your paper money is the day you give up your freedom. And I cannot be more serious about that. The day you give up your paper money is the day you give up your freedom. And you better remember that, and you better take note of this. Okay. That being said, I'm going to continue to keep an eye on this and see what happens with it. But like I said, it was mind blowing. And I wanted to share it with everybody. This kind of reminds me when you go back to like 2010, 2011, when you had the debt crisis in Europe, and basically the Greek banks did what they call the bail-in for the first time, where basically all of the Greek customers, it was like, no, the bank was freezing every customer's deposits. You could not come to the bank and withdraw money. They basically, they were going to use the customer's money to basically fix the bank's problems. And then eventually they relented a little bit, and they allowed people to go to the ATM to basically take money out. And I think you can only take up to about $400, US money a day over there in Greece. So it was a fascinating situation. And this in some respects reminds me of that. It's so kind of extreme and out there that like I said, it made it was just, like I said, a big thing. So, all right, so we'll keep an eye on that. And then, okay, other thing I wanted to share was this article right here. And this was called, this is from S&P Capital Intelligence, and it's called Boiling Down U.S. Bank Liquidity. And the reason why I wanted to share this is because there were some really great graphs in here. So this is basically the first graph we're looking at. And for the podcast audience, we're looking at a graph of the yield curve, which has been inverted much longer than in previous cycles. That's an understatement. It's the longest yield curve inversion that we've ever had on record. But the important thing I wanted to point out here, so we have a couple of graphs here. We have in the yellow, we have the 10-year treasury, and in the blue, we have the 2-year treasury. And I just want you to see here how, these things are starting to converge, and there's not much of a gap between these two rates right now. And you could see here that there's a major upward trajectory here. And if we cross it over, they're pressing against the 5%. Now, really interesting what the Fed did this week, or did, basically 2 weeks ago. I mean, the Fed basically said they were going to slow down their quantitative tightening. They were going to slow down the amount of runoff on their balance sheet. And obviously the bond and the treasury markets responded very favorably to that, ticking down the rates a little bit. Rates have backed off, 20, 30 basis points because of that. So the Fed doing that obviously to help out the treasury immensely. But like I said, I just wanted to note the trend here in the chart, and you could see this. I mean, this trend is that, the rate is going up. And this is the treasury market. This is the biggest thing, the biggest problem the United States has right now is right here in this treasury market. And what is happening is all of the money being rolled over, everything is basically in the 90-day treasury. Like that's where all the action is right now. That's where everything is being rolled over, because they don't want to do it in the 2-year. They don't want to do it in the 10-year, because then that's going to force rates up. They don't want to do that. They want to keep the rates artificially low. They want to keep the yield curve inverted, because they know that when it reverts back, look out, man, because you're gonna hit the wall. So the part of the reason why this has gone on as long as it has is because of what the Fed is doing. And the Fed has the Fed and the Treasury have been working together to kind of manipulate this going back to October of last year. So I mean, for basically about 6-7 months now. Otherwise, if you go back to late October, the yield curve would have reverted back to positive territory, and we would see Treasury rates that would be we would see Treasury if they didn't intervene, we might see Treasury rates up over 7% today if they hadn't done that. So again, just wanted to point out the trend here. So now let's look at some of the other things here. So now we have so this is a chart here of term funding concentration for the banking industry. So here we have CDs, CDs / total deposits in the blue. We have brokered deposits in the yellow, and then we have the Federal Home Loan Bank advances down here in the purple at the bottom. So we could see here that the Federal Home Loan advances have been kind of stagnant. They're just kind of hanging in there at around 4%. But we could see here that the brokered deposits have been going up very steadily and are now approaching back toward 8% there. But the big one here is the CDs, and you could see that the CDs have shot up here back up over to 15%. So in other words, how are banks funding themselves right now? Well, they're funding themselves through CDs, through brokered deposits, and through Federal Home Loan Bank advances. But the big bulk of that funding is coming through CDs. It's through through CD accounts. Now, where that gets important is in a bank's cost of funds. So that drives up a bank's cost of funds. In other words, what do they have to pay to get deposits that they need to help basically fund the lending? So they're basically having to pay up for that. And then as we go down to the next chart, we see here total loans and leases by total deposits. So this is your loan. This is what you call your loan to deposit ratio. Very, very important ratio. And we can see here that what happened here, 2019, 2020, you have all the pandemic funding. So banks get just absolutely flush with cash. So that causes the loan to deposit ratio to come way down here to even below, I'd say below 60%, probably 57, 58%. And now we're seeing that loan to deposit ratio go back up here. We're seeing it creep back up over 65%, probably 67, 68%. If I did an episode last weekend on where I kind of get in and talk a little bit about like bank liquidity, loan to deposit ratios, efficiency ratios, like definitely go check out some of those episodes I did last weekend. And then as we go down here, so here is CDs repricing in coming months on the rise. So we have CDs, we have 3-month, and then we have 12-month. And you can see here that the 12-month is obviously it's very high. You got a lot of CDs repricing here in the next 12 months. So and the question is like, what happens there? In other words, are those CD rates going to come down? Are they going to remain elevated? That's basically the $1 million question, as it were, right now. And then as we go down a little bit further here, we have deposits will grow again as spread between Fed funds and cost of deposits narrow. So basically here it says, the cost of deposits is directly correlated with the average federal funds rate, which on the bright side for banks has not been increasing as quickly in recent quarters. The average Fed funds rate was up 7 basis points in the fourth quarter, following increases of 28 and 46 basis points in the preceding 2 quarters. U.S. banks' cost of deposits rose 21 basis points to 2.31% in the fourth quarter of 2023, which was a smaller jump than in the third quarter of 2023 when it climbed 32 basis points. So again, so you have the federal funds rate kind of coming down a little bit here. Industry, basically industry aggregate cost of deposits kind of coming down a little bit. So we'll kind of keep an eye on that and see what's going in there. And then the last chart here. So this is U.S. banks grow non-brokered deposits for the first time in 7 quarters. So quarterly loan growth notably slowed in the wake of the Federal Reserve's rate hikes, but total loans and leases grew only 0.9% in the fourth quarter of 2023 versus 2% in the same quarter of the prior year. After accounting for seasonality, quarter loan growth has been declining since the middle of 2023. The book value of banks' securities saw some relief, however, up 2.5% in the fourth quarter of 2023 after 6 quarters of declines. So, quarter over quarter changes in U.S. bank aggregate asset composition. So you can see here things are kind of creeping up just a tad. Cash and equivalents going up here, total securities, a little bump, loans, not looking so hot right now. So, okay. So that was some great, couple of very good, interesting articles there that I wanted to share with everybody, just so we could see kind of what is happening right now in the banking industry. So now let's get on to the regular news and stuff. So let's get into economic reports. So what do we got on the horizon for this week coming up? So on Monday, we get consumer inflation expectations. On Tuesday, we get the PPI for April. The Fed Chair Powell is going to speak at 10 a.m. on Tuesday, and then we get the API weekly crude oil stock. On Wednesday, we get the CPI for April. We get the core CPI for April, and then we get the core retail sales. New York Empire State Manufacturing Index, we get retail control. On Thursday, we have continuous job claims. We get housing starts. Initial jobless claims, and then we get the Philadelphia Fed Manufacturing Index. Friday, May 17th, we get U.S. Leading Index, and we get the U.S. Baker Hughes rig count on Friday. So a lot of inflation news coming this week. The Powell's going to speak on Tuesday. My guess is that the inflation numbers, my guess is that the PPI and the CPI are both going to continue to be running way hotter than the Fed would like, and that Powell's going to say something about yada yada yada. We're going to start reducing the quantitative tightening. We're going to reduce the amount of runoff on our balance sheet here, and we're going to keep steady with interest rates. We're not making any changes to interest rates until more data. He's going to say more data, more data, more data. We also get like a little bit of jobless data. We get a little bit of real estate data with housing starts. So it'll be a busy week. Be a very busy week coming up. So let's see. Okay, so a couple other things here. Just a couple interesting articles to note. So Fed officials in a wait and see mode on rate cuts ahead of next week's inflation data. Yeah, so just like I said, Federal Reserve officials today say they were in no hurry to act on interest rates. So we got that. What do you need to know ahead of Wednesday's much anticipated CPI inflation report? So the CPI likely rose 3.4% over the year in April compared to 3.5% annual increase in March, according to forecasts. Inflation has stayed stubbornly high over the Federal Reserve's target of 2% annual rate in the first half of the year, despite high interest rates meant to push it down. Fed officials have said they won't cut the influential Fed funds rate, which affect borrowing costs for all kinds of loans until inflation is firmly on its way down to 2%, which is not going to happen. U.S. consumer sentiment shows its biggest drop in nearly 3 years. So the key takeaways here are the University of Michigan's Consumer Sentiment Index fell nearly 10 points in May to 67.4%, its lowest reading since November, and the steepest fall in the survey in nearly 3 years. Economists were expecting a more modest drop in the survey results. Inflation continues to worry the public, with consumers again raising their expectations for future price increases. U.S. consumers set to spend $33.5 billion this Mother's Day despite waning sentiment. So U.S. consumers are expected to spend $33.5 billion on Mother's Day this year, slightly lower than last year's. The average per person spending is also forecast to be down slightly to an anticipated $254 per person, with those aged 34 to 44 expected to spend the most at about $345. Strong Mother's Day spending comes on the heels of several months of better than expected retail sales, which have helped to drive economic growth despite persistent inflation. Yeah, so again, I keep saying this, you are spending more to buy less. I went into Walgreens to buy Mother's Day cards this week, and I got 4 Mother's Day cards and a couple of, I think I got like some toothpaste and something else. It was $46. $46. And I was like, what in the world? And I looked at the receipt, and some of these cards, these holiday cards, were $6. These were not, these weren't making sounds. These didn't have pop-ups. These didn't have none of that fancy stuff. These were just 2-sided cards. That's it. And one of the cards was like $7. Another was $8. Another was $6. Another was $5. Like, I mean, it just goes to show you. So yeah, I spent more money. I got the same thing that I've gotten every year for the last, 20 years. But it literally has cost me. I mean, those cards should be $2 a piece. It should have been $8. They're and then, I ended up spending $30 on cards. I mean, it's just, it's crazy. So, and I'll say that in a minute. I just want to finish these next 2 articles here. So, gold price on May 10th. So rate advances amid optimism of a Fed rate cut. So the spot price of gold rose Friday at the Atlanta Federal Reserve Bank president Ralph Bostic suggested policymakers remain on track to reduce borrowing costs this year. So the gold spot price was 0.8% higher at $2,364 per ounce as of Friday. So the price of gold continues to go up. And just so everybody understands, gold is a proxy in a very real way. Gold is a proxy for the job that the central bank is doing. If the central bank, and this is why central bankers kind of, in a very real way, despise the price of gold, because if gold is way up, that signals that the central bankers are not doing a good job. And so the price of gold right now should tell you everything you need to know, that basically the central bankers are doing a crap job. And that's why the gold price is way up, because people want to hedge against the inflation and against the collapse of the US dollar, basically. Is renting the future of single family homes? Builders are constructing more single-family homes intended to be rented out instead of owned by the occupier as home ownership becomes more financially difficult amid high interest rates and prices. Renting a single-family home is a way of gaining living space while keeping the flexibility of renting and can be a more affordable option. Builders often cluster large numbers of units together in a single development and offer amenities similar to those found in luxury apartment buildings. All over the country, developers are putting up neighborhoods of single-family homes that are never intended to be owned by the people who live in them. Let me say that again. All over the country, developers are putting up neighborhoods of single-family homes that are never intended to be owned by the people who live in them. That's just wild. I mean, you look at the price of housing and the price of cars, and it's just insane. I mean it is becoming so expensive that in a few years people won't be able to they won't be able to buy anything. You're not going to be able to buy a house. You're not going to be able to buy a car. I mean, it's just nuts. And I could go on a whole diatribe about the car industry. Where are the affordable cars for people? Where's the Honda Civic that was $20,000? Where's the Kia? Where are all the cheap? Where's the little two-door hatchback coupe? For somebody in their early 20s, just needs something to ride around in. Where's the Toyota Corolla that's 1999? What is happening? And yet we have all these cars now that are over $100,000. I think there's over 32 car brands now that all have a car, and I'm talking about sedans, trucks, over $100,000. How many people out there can afford to buy a car for $100,000, finance it over 5 years, and then pay that bill every month? I mean, it's crazy. It's crazy. And we need something. And again, and their answer to a lot of this was the electric cars. Oh, the electric cars are going to solve all our problems. Yeah, hardly. And this is why the consumer sentiment is plunging right now. This is why the consumer sentiment is plunging. If you look at the numbers, you've got credit card debt at an all-time high, well over $1 trillion in credit card debt, the highest amount of credit card debt that has ever been in this country. You have the buy now, pay later exploding, because basically people, their credit cards are tapped out. They got to use the buy now, pay later. And now they're starting to see all kinds of delinquency on the buy now, pay later. And then you've got consumer savings has crashed through the floor. I mean, I think the average person in the United States right now has $400 in their savings account. $400. This is just, so you combine those three things together, and then you add in the cost of housing, the cost of cars. So it's no wonder the consumer sentiment. And again, the idea of consumer spending, it's totally false. I mean, you look at that number, you're like, oh, look, consumer spending is up. That means everything is great. The consumer is just so strong and they're just out there spending. No, they're spending that money because they have to, because all of the prices have gone through the freaking roof, and the consumer has to be out there. They have to spend that money just to continue to live. So, okay. So let's hit a couple of big things here. The couple of news items here. So the 6 largest U.S. banks could suffer a potential rise in loan defaults due to climate change risk in 10 years. But the financial institutions noted they can rebalance their portfolios over the forecast horizon to significantly mitigate the risk. The Federal Reserve found in a climate stress test analysis published May 9th, JP Morgan Chase, Bank of America, Citigroup, Goldman Sachs, Morgan Stanley, Wells Fargo participated in the study, which was announced nearly 2 years ago and conducted in 2023. I also have some more. Let's see this. Hold on here. This is the FDA. Hang on. I want to find this because where is this? Here we go. Okay. Fed report suggests climate risk is difficult to measure. So this is the same report. The Federal Reserve Board released a summary of an exploratory pilot climate scenario analysis exercise that it conducted with 6 of the nation's largest banks, with the mega banks reporting challenges in conducting the climate analysis. The Fed conducted a pilot climate scenario analysis exercise in 2023 on large banks' ability to identify and manage climate-related financial risks. It said the pilot was exploratory and does not have consequences for bank capital or supervisory implications. Yeah, I mean, it's just it's a hooey bunch of like. I'm not your climate person. I don't like this ESG stuff. I don't go with it. I think a lot of this stuff is just nonsense. And they keep doing these studies, they keep doing these reports, trying to prove that in 10 years the world's going to end, and if the banks don't stop financing fossil fuel companies, it's all the world's going to end. It's nonsense. It's nonsense, and it needs to stop. Okay, on to the next thing. Okay, here. So now we got. Customer satisfaction at digital banks has declined over the past year, American Banker reported, citing survey results published on May 9th by an industry performance monitor, J.D. Power. Although the research shows people are still happier with digital-only banks than traditional banks, the decline in satisfaction was statistically significant, the report said, citing Paul McAdams, Senior Director of Banking and Payments Intelligence at J.D. Power. So that's kind of interesting, so basically people are not as satisfied with the digital banks. I'd like to probably dig into that report and find out a little bit more. They said it was statistically significant, but what does that really mean? Here's a crazy story. The Ohio Attorney General, David Yost, is investigating the state teachers' retirement system of Ohio amid allegations that an allegedly hostile takeover is putting educators' money in jeopardy. News 5 Cleveland reported the teachers' pension fund allegedly lost $27 million from investments in a failed Silicon Valley bank, and the cost of living adjustments were suspended for more than 150 retired Ohio teachers for 5 years, starting in 2017, the report said. Wow. I suspect that there is going to be a lot more to come out about that one, but that sounds pretty crazy. Mutual funds are being closed at a faster pace than they are being launched in nearly a decade as investors increasingly shift to low-cost, tax-efficient exchange-traded funds, Bloomberg News reported. Okay, now let's get to the big, juicy, spicy issue of the week here. So, FDIC investigation. A survey by the U.S. Office of Personnel Management conducted from August 7th to September 29, 2023, indicated that only 39% of workers at the Federal Deposit Insurance consider the agency's leadership as inspiring, strong motivation, and commitment, a decrease from 61% in 2020 and 11 percentage points below the government average, Reuters reported. The survey also showed that 38% of staff were mulling exiting the agency within the next 12 months, more than double that of 2020 and higher than the government-wide figure of 33%, according to the report. More than 80% of workers who said they are considering leaving the agency cited remote work arrangements as a factor. A recently released independent review of the agency's workplace culture found that sexual misconduct and bias are rife at the FDIC and that the regulator has failed to provide a workplace safe from discrimination for far too many employees and for far too long. That is crazy. FDI, and then here it continues on. FDIC issues third-party report on misconduct at the agency. So the FDIC released a report from an independent third-party review. Basically, the report details found the FDIC has failed to provide a workplace safe from sexual harassment, discrimination, and other interpersonal misconduct. Found management's responses to allegations of misconduct, as well as the culture and conditions that gave rise to them, have been insufficient and ineffective, including recommendations for protecting victims, transforming the agency culture, holding leadership accountable, improving transparency, and more, was based on the experiences of more than 500 current and former FDIC employees. In a message to FDIC employees, FDIC Chairman Martin Gruenberg said he was sorry to anyone who experienced sexual harassment or other misconduct at the FDIC, apologized for shortcomings on his part, said he is ultimately responsible for everything that happens at the agency, and pledged to implement the recommendations contained in the report. Yes, that generally means that he needs to exit stage right. How you have the guy who oversaw all this stuff for the last few years is going to be responsible for cleaning it up. I don't really know how that works, but yeah. So everything at the FDIC is a hot mess right now. Hot mess. Okay, so I'm gonna end with this last thing here. So 5 institutional prime funds, including that of Goldman Sachs Group and Vanguard Group, have announced plans to convert the government-only holdings or close altogether ahead of the SEC's rule changes that will take effect in October, which will make withdrawing money from some funds more expensive during financial stress. Very fascinating. So again, I have to say it again, 5 institutional prime funds have announced plans to convert to government-only holdings or close altogether ahead of the SEC's rule changes that will take effect in October, which will make withdrawing money from some funds more expensive during financial stress. A logical person might ask the question, why are they doing that? Why did that fly under the radar this week? So in other words, if we have a financial disaster, they're basically Goldman Sachs and Vanguard are basically going to take your money and they're going to seize it and they're going to turn it over to the government, and you're not going to be able to withdraw it. You're not going to be able to get to your money. Kind of sounds like a bail-in from Greece, what I was talking about earlier. Yeah. Also plays in to this book, which I need to review here, called The Great Taking by David Rogers Webb. This whole book is about exactly that. Is about how basically the securities that you think you own in retirement accounts and brokerage accounts, you don't have as much control over those as you think, as per the UCC Uniform Commercial Code. I'm still reading through this book and I'm still researching it, but it is very fascinating. Very, very fascinating. And when I saw that article this week, it immediately drove me right back to that. And I said, yeah, there's something going on there that needs further, deeper investigation. So anyway, that's what I got. I mean, and unfortunately I had a lot more than that, just did not have time to get to it here as I try to keep this to 30 minutes. But again, hope everybody enjoyed this episode. Please make sure to like, share, and subscribe. That always helps the channel. Please make sure to leave your comments down below. I will have some other episodes along with this one today, and there'll be some other episodes this week. If you're not following the Lords of Easy Money series, please make sure to check that out. I posted episodes 13, 14, and 15 last Thursday, and I'll have and we're now moving into the final part of that book, the last 4 chapters. So I'm going to have 2 more chapters this week, 2 more chapters the week after, and then I'm going to do a final wrap-up episode on the Lords of Easy Money. So if you have not had a chance to check that out, please do so. And again, I hope everybody has a great Mother's Day. Hope everybody has a great weekend, and I will be back to see everybody again next week. Thank you so much.